another thing I like to look at is the largest gain and the largest loss. And when you look at largest gains and largest losses in any, one period, like maybe a week or a month or so, yeah, you might get torpedoed on a stock. Maybe a company comes out with an earnings report and you get nailed on it, and you take an outsized loss. But when you look at it over a period of 6 months or 12 months, and you run an average of all that, in this instance, you can see the average over a year is 18.43% for the largest gain, 8.37% for the largest loss. That number doesn't lie. If you're consistently having or averaging larger losses than your largest gain, you're not managing the risk reward relationship. You're not managing the risk reward relationship well. And then to take it to a step further is to look at how many days you're holding your losses to how many days you're holding your gains. And when that's inverted, in this case, 26 days for the gains, 11 days. See, all this is basically a ratio, a positive ratio, just like the reward to risk. We want all this to have a positive ratio. We want to be basically riding our winners, bigger winners than losers, holding them longer than our losers. This is what I call the stubborn trader indicator. So when you see the largest gain is smaller than the largest loss, and you see that your time that you're holding your losses is longer than you're holding your gainers, on average, over a period of time, 6 months, 12 months of trading, it means that you argue with the market. You don't take your losses, and you hang in there and you hold them. You're not letting your winners ride and cutting your losses quick. You're doing the opposite. And this is where you really see the truth about your trading, and you know exactly where you are and what needs to be fixed. And this is the starting point. Now, all this is going to distribute. If you were to take your trades, and this is another, we also have this on our program, the trading logger. I'm sorry, I'm getting a brain fart there. On our trading logger software, where you put your trades in, and it will distribute all your trades over a bell curve and then chop them up into these increments. So now you can see where are your 0 to 2%, 2 to 4, 4 to 6, and so on. How many trades do you have in those slices versus the loss side? And basically, it's just a distribution curve of your wins and your losses. You can do it however you want. You want to make it a little bit more granular, you can go in 1% increments, however you want to do it. Again, you can do this all in a spreadsheet, in an Excel spreadsheet. Now, the key is that you want to have a skewed bell curve, right? If the bell curve is perfectly distributed and even on both sides, well, you're a break-even trader. Your losses are basically equaling your gains. So you want that to skew on the right side. But one of the main things about this analysis and letting your trades, putting your trades on a spreadsheet, looking at a bell curve, actually physically seeing your trading, is that when you're in the trading environment and you're trading, this is at least the way I think about it. I say to myself, the stock is starting to get down there and it's getting to 4%, 5%, 6%. I start to think, I don't want to see that. I don't want to see that trade sticking on the left side of my curve. I start thinking of my bell curve, and I want this to be clean on the left side, and I want that right side to tail out. I want outliers, right? That's a skewed bell curve. I want as many standard deviations to the right as I can. So thinking in math like that, I automatically know, okay, my average gain is 10%. Well, if my loss starts approaching 10%, my plane's going upside down here, right? I've now got that reference point. So very important. What I call is building the wall right on the left side here. I have an uncle point, and that's at the 8% mark. That's it. I'm not going to allow a stock to get through there unless it gaps, and there's nothing I can do about it. And you might have a few outliers that get through there, but the goal is, of course, is to let the right side develop and cut off the left side. This is what we call creating asymmetric leverage. That's when you put yourself in a situation from this point, right? This is the breakout, right? From that point, there's this much potential on the upside. And even though there may be, let's call it equal potential on the downside, you are clipping it off. You're cutting that downside off. So now you have now created asymmetric leverage. You've made your odds, right? You're not, because you're not going to get the odds. You're not going to necessarily get those odds. This is a moving target. And with stocks, Some stocks are going to go up X amount. Some stocks are going to not go up much at all. Some stocks are going to go down. But so the only thing that you have are your own results and what you can rely upon based on what your strategy has produced. And the whole idea is to get as close of an idea as you can of what you can average on the upside. It doesn't have to be in any one particular trade. It's what happens over time, right? That's why I'm giving you these examples of guy walks across the street 100 times, not just one time. So for instance, if you were to play aces and you lose with aces, well, doesn't mean you stop playing aces, right? You know, if you play aces 100 times versus a guy who plays a pair of twos, your heads up, you're going to win. You're going to win over time. So this is all about what happens over time. All right.
I want to add, Mark, too. This is on one of these charts. I just feel like, folks, you've got to burn this one into your brain, because, you know, as you look at this, you can see, you know, around sort of the peak of the distribution and the meaty part, you know, it kind of, everything comes out in the wash, where everything is, if you don't wall off that left-hand side and allow your right tail, you know, there's where all your profitability really is going to lie, because a lot of those, you know, plus and minus fours, they tend to rinse out. But if you don't build that wall, the only thing you should have, you know, say past 10%, is that occasional gap, or, you know, once a year, every couple of years, something, you know, sort of blows past a stop that you can't avoid. But even then, I think, if I've done mine before, my worst single trade was a 30. Well, I've got some that are out 80, 100. I've got, my tail goes way out to the right. And that's where all of your profitability is ultimately going to lie, in your ability to wall off the left-hand side of the curve and push things out to the right.
Yeah. And so this is going to all culminate to, everything comes down to math. All right. It's all going to come down to math. All the charts, all that stuff, that's great. But the bottom line is, we have got to make more money on our winners than we lose on our losers, and netted out by how often we're right is going to create our edge. And this is another result-based assumption forecast, is another calculator, if you will, that we have on our platform that you can put the numbers in. And I've played around with this for years and years. I had this in an Excel spreadsheet. I know a lot of people I've seen on Twitter have read my book and they developed this on an Excel spreadsheet. It's pretty easy. What this allows you to do is put in your, say, a goal. Say your goal here is desired returns 100%, and then put in the numbers that you're getting on your trades. So you look back at 100 trades that you did, you got 12% on your winners. Your losers were average 6%. You're right 50% of the time. Well, that's going to tell you now what it's going to take to get to your goal, right? How many opportunities you're going to need, because this is a big part of the equation. And you look over here, 134 trades are going to be needed to reach your goal, right? So this just tells you what your profitability is. You're gaining, in this particular example, $200,000 portfolio, 25% positions. You're gaining 6,000 on your winners on average, losing 3,000 on your losers, 2 to 1, right? So now turn that over to get to that 200,000. You have to do that 134 times. Well, if you're a day trader, that would be doable in a very short period of time. You might, I have friends that are day traders, some of them do thousands of trades in a day, which sounds unbelievable, but that they actually do that. And then with my type of strategy, I usually trade anywhere between 150 and 500 trades a year. So again, this would be very doable for me to get to that 100% return with this type of position sizing. So these are numbers you can play with as far as forecasting as to what your current results, where it would get you, and then contrast that to where you're at, and then you can see what needs to be improved. You know, if you've got a 3% average gain, and even if you had a 1% average loss, well, you'd have to do a lot of trades, right? You have to turn that over quite a bit. And is that realistic? So, and then if your numbers are inverted, obviously you see that you'll have to improve, maybe holding the stock longer, having better stock selection, and improving that average gain. So the whole idea, the whole goal of this is to get to the truth, find the truth of where you're at, and then that's where you can now bridge the gap of where you need to go. And knowing the math behind where you need to be creates, and it's not, Mark, you said this before, these are not gigantic changes, like small changes. You'd be surprised. You use a calculator like this and you just change the batting average from, say, 38% to 44%, and you improve your average loss by 1%. All of a sudden, bang, you're wildly profitable with just small changes. just move on here.
Yeah, I'll just add to that. I think oftentimes, novices think, yeah, that the difference between, the seasoned professional and the amateur is this gargantuan mile-wide gap. And to Mark's point, it's actually it's these very small attention to detail areas. And when it comes to risk management, this is precisely why you have to, again, to the probability distribution curve, you have to make the wall there. No one else is going to do it for you, meaning you have to be militant about not allowing those losses to get out of control, because it only takes, a few of those to really make a drastic negative impact on your performance.
So one of the big questions that I often get is, well, then how do we know what the expected gain is? If losses are a function of expected gain, how do we know what to expect? Well, and this is where we are in a very inexact science, right? Because we're dealing with assumptions now. And how well you make those assumptions is really important, because your risk is a function of that. So there's two types of assumptions, right? There's a theoretical, or what I call a theoretical based assumption, and then a result based assumption. A theoretical based assumption is an assumption that you come up with based on, whatever your analysis is. Some people use a swing technique where they measure a measured move, where they measure the top of the base to the bottom. Let's just say it's 20% decline, and they say, well, now it has a 20% chance to go to the upside. There's all types of ways we can come up with targets and come up with an expected gain based on a theory or an assumption. But the problem with an assumption, or a theoretical based assumption, is that it takes out one of the most important variables, and that's you, the operator, the person. Even strategies, we found that strategies that are mechanical, and you get basically a buy and a sell, like a moving average crossover or something like that, people eventually stop following the signals. They don't execute it perfectly. You'll get a buy sell, and they'll get a whipsaw for a couple of times, and then they'll distrust the signal. So there is the foibles, the idiosyncrasies, the fear, the FOMO, all the things that come with trading are boiled into your results, your strategy. And this is why you have to have a very consistent application of discipline. Trading from these reference points. Again, there's so many reasons why reference points are important. And another one is, so you're having a consistent environment that you can now count on that data being accurate and something that you can rely upon. And again, you don't have to know what hand aces are gonna win, or what trade is going to be a 15% winner or a 10% winner. What you need to figure out is approximately what you're going to average on the winners, and approximately how often. Once you come up with that number and you can get a fair idea of what that number is going to be, the loss side becomes a mathematical equation. But in this example here, if we were to make that loss decision based on a theoretical based assumption, which we're going to call it, say, well, 20%. Technical analysis, we're using a 20% target. So we use a 10% stop, right? That's 2 to 1. We're going to cut our loss. We're going to make our odds 2 to 1. But in fact, even in those environments where you get those stocks that go up, you cut that off. You sell early. You have a tendency to sell, and you only average 10%. Well, now to get that same 2 to 1, you'd have to use a 5% stop, but you'd be using a 10% stop based on this theory. But in real life, that's not really what's happening. So what I do is I use my own results, and I try to be as consistent as possible and optimize my strategy so those results become very reliable. And it takes time to get to that point where you're going to get those reliable results, but you will. And even when you don't have a reliable strategy, let's say you're all over the place, you're still going to produce a result. All right. And I assure you that whatever you're doing, that result will be, at some point over a number of trades, is going to be pretty consistent. You'll sort of fall around that same number consistently, because again, it encompasses you overriding the strategy as well. So now, as that number improves, you're going to try to optimize that number, obviously. Over time, I've gotten to a point where I can't seem to increase it by a whole lot. And maybe I'm not optimizing it it to the fullest extent that I could, but I'm optimizing it to maybe my fullest capability of how I run my strategy, or with my own comfort zone. So that number's become very reliable for me of what my upside number is. And now I can set that stop, and I can know, what I need to where I need to be on the risk side, with it's just a mathematical equation at this point. I don't know if you have anything to add before I go on. I'm going to go on to the next slide here, Mark. We're going to change gears a little bit.
No, yeah, go ahead. And this is it's all going to continue to sort of flow together here.
Yeah. So again, we're going to slice these numbers in a couple more ways. I want to show you how losses and how this win-loss ratio, all right, and thinking in terms of sometimes things are counterintuitive, and even when you raise your upside, right, your expected gain, let's just say as a short-term trader, your expected gain, you've been averaging 4% gains. So you want to get that 2-to-1 ratio. So you're cutting your losses at 2%. Okay, if we're going to assume you had a 40% batting average, all right, somewhere around what Mark said that he runs at, a 40% batting average. If you were to do 10 trades with those numbers, you're getting 4% on your winners, losing 2% on your losers. Over 10 trades, your ROI would be 3.63%. You'd make about 3.5% on your money. Okay, so now common sense would say, okay, well, if I move to 8%, well, then I got to cut my loss at 4%, right? To maintain that 2-to-1. Absolutely. So now we move up to 8 and 4, and we make 6.49% on 10 trades. And as we move up here, we're going to keep maintaining that 2-to-1. So you might think, well, then if that's the case, then this would apply even if I was a long-term investor and maybe my average gain was 80%. I can take bigger losses, right? Not necessarily true. That's not true. So once you get below a 50% batting average, when you fall below 50%, what happens is, and you're going to fall below 50% at some point, or even maintain below 50%, as Mark said, his long-term average is below 50%. So what that means is that there is an optimal level of risk versus reward. You can't just increase proportionately, meaning that if you get into a volatile environment or a volatile stock, you can't just increase the loss. The loss still has to be capped. And let me show you how this works. So this is really, really important stuff. Not all your ratios are created equal when you fall below 50% batting average. And there's a couple reasons why this is important, but let's first just look at the math. So if you're at 42.21, where now it's still your 2-to-1, you can see it here, it's a little bit small here, and you're at 40% batting average, you're actually losing a little bit of money. You're just below break even. Step it up to, you go up and almost double it to the 80-40. Now you're making 80% on your winners, losing 40%. Still 2-to-1, right? So you should be making money? No. Move over to the right here. You're gonna lose 51% of your money in 10 trades. How is that? I'm making 80%, I'm losing 40%, because losses work geometrically against you. So even if you raise your gain proportionately, you can't just make the loss bigger. You have to actually make the loss smaller. You have to truncate the loss for the volatility. So the general rule is that the more your batting average falls below 50%, at 40%, 10 trades at 80-40 you'd lose 50% of your money. But if you step that up and you go to 90-45 and you increase that downside to 45%, you widen that, you'd actually lose more money. So there's an optimal level where any less, any more, you make less. If you have a smaller ratio, you make less. If you have a larger ratio, you make less once you fall below 50%. So the reason why, and I'm going to skip a slide here, I'm going to go from 436 to 437, then we're going to go back to 436. The reason why, and what this means, is that what happens a lot of times when people experience volatility, and so they use a stop loss, and then the stop gets triggered. Let's just say you put an 8% stop. It goes below, it goes down 15%, then turns around and rips higher, right? and you're going, oh man, if I should never listen to Mark Minervini and taken an 8% stop. If I just held this, I would have, I'd still be in the trade. So you say, well, you know what? Things are a lot wider and more volatile. I'm going to increase my stop. Well, at some point you hit a point where even increasing it proportionally to your upside is not going to get you anywhere. Matter of fact, you might be losing money even increasing proportionally. So when you get into a difficult period like we are now, and you're getting volatility, first of all, you definitely want to be off margin, because that's going to increase all this, the upside as well as the downside. But the main thing is, what you have to realize is that you need to actually cut your losses even tighter, not widen them. So you start with this maximum loss, that I'm telling you, and we're going to get into that in a little bit more. But as volatility increases, the last thing you want to do is increase your downside, which is that's a sort of a natural tendency. That would be your normal, common sense would say, well, I'm going to increase the downside proportionally, I'll still be okay. No, you actually have to tighten it up. Mark, in a very volatile environment, what are the things that you do to account for the volatile environment, to compensate for the volatility?
Yeah, three things. One, trade smaller, trade tighter, and trade less frequently. And this is, to Mark's last point, precisely the opposite of what a lot of folks do, and even a lot of professionals. Will say things like, "Oh, just widen your stops." And if this section of the program doesn't teach you why you don't want to do that, it is precisely because these losses are working geometrically against you. So why do you want to increase the size of them? Is precisely the opposite of what you want to do, and also why we're going to get to one of the other slides that shows the bigger the drawdowns, because the harder they are to come back from. So you want to, the one thing, remember from earlier, what do we have control over? We have control over that loss. So when things are not going well, you need to tighten that up, not loosen it.
Right. And while I'm showing you here a little bit tactically of what needs to be done, the big goal right now for me is to convince you and to show you why you need to draw that line in the sand, like I did after I ran those numbers and realized that I adjusted the loss, and all of a sudden my performance got so much better. And by the way, since I did that, I never had a down year from that point on. I've not had a down year, not one single year since I drew that line in the sand. Now, that's not the only reason why. There's other things skills that have to be developed, but that is the main reason. Without that, no matter what I do, is going to be sabotaged. So while there's some tactical things we're talking about, this is a mindset, and this is a risk first approach, where what I'm trying to convince you of is you have to draw a line in the sand, and that has to be in stone, right? You're not. People say, well, how about if it goes down intraday? If the stock's down 20%, and you have an 8% stop, are you going to wait till the end of the day to see how it closes? No, of course not. But if it goes down 20% intraday, what if it doesn't come back and it goes up? Now I moved past that left side, and I'm taking that risk of having that outlier to the left. I got to wall that left side off, right? So let me show you another example to bring this point home, to show you that no matter how you slice and dice numbers, risk losses work geometrically against you. And even if you have equal reward, it doesn't pay for it. It doesn't pay for the risk. You've got to have a ratio. You've got to be getting odds on your money. You always have to be getting odds on your money. So in this example, you've got a choice. I'm going to give you a choice to pick 9 different sets of returns over a 3-year period. So you can have 10, 10, 10, all the way up to 90, 90, 90, meaning that you're going to have 2 years of a 66% batting average, 67% batting average, two out of 3 years up, 1 year down, equal percentages. All right. 10% increments spaced out from 10 to 90%, meaning that if you were to pick 10, 10, 10, well, year 1, I'd give you 10% on your money. Year 2, I'd give you 10% on your money. Year 2, it goes down by 10%. What would your return be on these various calculations, and which one would you pick? What's the optimal? What's the best number? Well, the best number is 30, 30, 30. That's the best one. Now notice that any less or any more, you make less. There's an optimal ratio, right? So, but the other thing to understand about this is that if you look at the returns, there is no good number. 30% a year. Now you think to yourself, well, I make 50% a year, then I make 50% and I lose 50%. How could I not be making money and doing really well? Or 30%, 30%, and 30%. Two times I'm making 30, only one time I'm losing, because losses work geometrically against you. You're compounding. So the best that you're going to do under any of these scenarios is 5.8% a year, which isn't even worth going into stocks. And so the lesson from this is that you have to be getting odds on your money. So now if you were getting 40% in year one and 40% in year two and losing less, now your return would be much better, right? Now you're getting odds. If you were getting 2-to-1, that would mean where you'd have to get 60% in year one, 60% in year two, you're getting 2-to-1 with a 67% batting average. You'd make a ton of money. Your return would be huge. So you have to keep your losses in check with your gains, but you have to be getting odds on your money. That's the lesson here. The other lesson is, and this is what you should go back again, get into the truth of your trading. And this is what I did. This all just is circling back to the very beginning, and where I looked at my results and seen that I was cutting my losses, but every now and then there was a 30 in there. There was a 40, there was a 50. There was a couple big ones. And those were just this one-time moment. There was a time where I remember with a company called 50 Off Stores. I was so enamored with the stock that I talked to the company. I talked to the CFO. Peter Lynch was buying the stock. I heard that he was at the company talking to the executives, and I fell in love with it. I already made money in it, and I traded it great from a big coupled handle in the 1990s. But then I fell in love with it. And I had this one-time moment. It came down, and I said, you know what? I believe in this company. I bought more, and I bought more, and I bought more, and it ended up causing a big problem for me in my portfolio. And I could tell you right now, when you have just this one-time moment, it's never just this one time. It's a slippery slope. Nobody has a just this one-time moment. Nobody goes to the refrigerator when they're dieting and just takes one little thing of ice cream and only does it one time. Nobody cheats with smoking and has just one cigarette just this one time, or one drink. It's a slippery slope. It's a very slippery slope. And with trading, you've got to be 100% disciplined and resolute. Mark, how many times have you had a stock, blow through your stop or go down big, and you say, you know what, just this one time, I'm gonna hold this loss, and I'm gonna add to the position because I believe in the company so well, and I'm gonna just this one. How many just this one time moments have you had in your career?
Zero. One of the things we often say in our office, or we enjoy, is when people ask you, when do you break the rules? Because Mark always says, if you're breaking rules, you don't really have rules, or what I often say is, when rules become guidelines, they're not really rules. Like, meaning if they're not set in stone, then you don't really have them. So absolutely, if a market goes through my stop, say on a gap, I am out. I don't wait around. I don't hope and pray. It's you follow the discipline every time.
Yeah, you can't have not even one just this one time moment. And we're gonna end with that too. Just remember, when I end, we're gonna end on that, why you don't have just this one time moment. So if you're having trouble with your trading, right? Any of us, if we're having trouble with our trading, this is all about getting to the truth, finding out what's going on, and then bridging the gap from where you are to where you want to be. So there can only be a few things wrong if you're having trouble with your trading. Either you don't have a good strategy, you don't have an edge, your criteria is flawed, or you've got great criteria, but the market is hostile. That's a perfect example for now. Breakouts are not working. Does it mean I can go and buy a stock that's set up perfectly and is breaking out of a nice VCP, and most of them aren't working because we're in a bear market. The market's hostile. Or the third would be, I'm not following my own discipline. I got a great market. I've got great criteria, but I'm not following the rules. And this is where your failures are going to stem through either faulty principles or faulty discipline. So we're going to give you the principles. We're going to give you the tactics, the techniques, the principles, show you exactly how to do it. But the discipline, that's up to you. That's up to you. And that's where I've got to build this case, because so many of you are going to hold a stock when it's down. Stock's going to go down. It's going to turn around and go back up. And it's going to, maybe it happens a number of times in a row. And you're going to be like, why am I cutting my losses here? Might as well just hold this. This is Amazon. It's not going out of business. And then you're a dead man. Okay. It's you're walking dead. It's just a matter of time and you will blow up. I give you a guarantee of that. When you get into that mindset, if you can't manage your risk religiously and you have these just this one-time moments, eventually you will take a big loss, and all your performance, you'll have mediocre performance over the long term, because these occasional disasters will kill all the progress that you've made. Just like if you own Amazon went up 80,000%. So you hold it for 80,000% for 20 years, and then you get a market like we have now, and you hold it down 50%. You didn't lose 50%. You lost 40,000%. Okay, so losses work geometrically against you.
Mark, I just want to add to that, the last slide too. I think it's really important that bottom trading failures, meaning what's ultimately going to cause failure, is not a hostile market. So if you look at the difference between sort of the 1, 2, 3 and the AB, like right now, and what we often tell folks is, look, if you're having a tough time, it's either because, your criteria is flawed or the market's bad. Well, we know, not just based on history and Mark's performance and mine and others, the criteria is not the issue. So that if you haven't learned that to this point, it's not the criteria. So the only way you're going to fail in the long run is, again, either you're not following through on the discipline or you're arguing with the market. So staying disciplined is going to keep you in the game when the market is hostile. And that's precisely how, Mark, how many bear markets have you been through now, Mark?
I think this is my 9th.
And you're still alive. And this is precisely why these bear markets weed everybody out, because, they have faulty discipline or faulty principles.
Yeah. And see, what we have to create, the goal of, or the job of a coach is not just to teach the player how to swing a baseball bat or throw a football. There's a much bigger job. And my biggest job here is to show you the tactics and the strategy. And that's what people come to these kind of workshops. That's what they want. Give me the tools. I want the tools. Show me how to do this, read charts, all this. But that's not what's important. That I would be failing as a coach if I gave you all the tools and let you leave with all the tools without giving you what's really important. That's 2 things. One is to convince you that you can do this. That's more important than anything. That's why we have leaders and examples, and that it's people that someone like myself who came from poverty and made it up through the ranks and built my wealth by doing this, makes someone else believe this is possible. I can do this too. He did it, right? It wasn't some special person that was born with a special talent, and that's really important. And the other is to let you understand the truth as to what exactly you have to do and the discipline behind sticking to those tactics. The discipline behind it is what's most important, and convincing you of why you should do what I'm asking you to do. Because if you don't have a why, if you don't understand why and understand what the reasons are behind it, then you're not going to just blindly believe it unless everything's going well. When everything's going well, yes, you'll believe all my tactics. You'll say, yeah, they work. But when they're not working, which inevitably you're going to have periods where things are not working very well, that's where you've got to stay committed, and you've got to understand what's going on and how to navigate it, and to keep you in the game and to keep your confidence and still believe that you can do this, because this business will beat you up and beat your confidence up worse than anything, and will convince you that the end of the world is coming. A breakout is never going to work ever again. you can't do this. You're not smart enough. You're just, you can't handle it. You don't have the stomach for it. I mean, so many things will come when it's going bad, because there's this emotional pressure, and there's a financial pressure. The financial pressure, it's like a double, a double-edged sword. Let me move on. I know I'm going on and on here, but in the sake of time, I got to move on. So by measuring your results and knowing all this information that we just talked about, your instrument panel, making sure you're flying the plane upright, understand the risk reward relationship, the batting average, having a high batting average, understanding that math, that building in the failure, the small losses and building in the failure actually is empowering. It actually helps you to bulletproof your strategy. When you start to understand all this, your bell curve, where your gains and losses are distributing along that bell curve, what happens is you start making better and more accurate assumptions. Your loss cutting becomes more optimal, because now you know where you are on the upside, and your batting average, now you know where you need to be on the downside. And what it does is it improves your decision making in real time, because now when that loss pops up and you're in a trade and you start feeling unsure what to do, the math guides you. You know where you're at, and you know what needs to be done, not what you want to do, not what emotions are telling you to do, what needs to be done. So the next time that you're in a trade and you're about to make a trading decision, let's say you're in a trade, it's moving against you, and there's a loss, and it's ballooning, and it's at 4%, it's at 5%, it's at 6%, and you've got this urge, you don't want to take the loss, you don't want to admit you're wrong, you don't want to lose the money. Ask yourself, how is this going to look on my spreadsheet? How is this going to look on my bell curve? Where is that? That thing's in 10% loss. It's going to be sticking up on that left side, and you got to live with it for the rest of your life on your bell curve. Okay, so this is where the spreadsheet makes its way into your trading, and it becomes a strategic tool. Very important. All right, let's move on. So we get a lot of questions about stops, as far as, okay, so are you setting the stop based purely on math? Because we talk a lot about math, and then we talk a lot about charts too, on where the pivot is, and if the pivot fails and so forth, and the bottom of the base of where to set these stops. So there's two types of stops. There's a technical stop, where you're going to set it based on where the chart sours. So maybe you use the low of the pivot, the low of the base, where your pullback, you're pulling back to a certain moving average, whatever it is, it would be a technical stop that you're using the price action of the chart as to tell you when to get out. Well, then there's the mathematical stop, the pure mathematical stop, where you get to a point where, mathematically, I can't take any more loss here, because my gain doesn't pay for it. My average gain is 10%. I'm at a 9% loss. It's heading towards my average gain. That's something that just is mathematically not a smart thing to go beyond. So I've got to cut it at that mathematical level. So mathematical stop would be, I know I'm getting 10% on average on my gains. I'm right 50% of the time. I want a 2-to-1 reward to risk. Well, I got to cut my loss. I have to average. My losses have to average at 5%, right? That's another thing too. Remember, it's where you average. It doesn't mean that you make a hard line in the sand and say 5%, that's where you want to average. Whatever your maximum is, and we're going to talk about this in just a second, wherever your maximum is, it's always going to be less than that. You're always going to average less than that, because that's your max, and you're going to take losses that are less than that, so you will average less. So now the goal is to use the risk, okay, as actually a selection tool, as part of the selection process. So that's what we call backing into risk. So when I look at a chart, and one of the reasons why we're going to have this tightness on the right side is not only because it creates this explosive potential from a supply-demand imbalance, which is the most important reason, but again, it creates that reference point, and where I know what's normal and what should be abnormal. And the tighter the price is, the more the abnormal activity will stick out and get me out of the trade and tell me, hey, technically this isn't working at a mathematically acceptable level, right? Because now if that right side is 2%, and I'm saying, well, technically, the bottom of that, of that pivot point, that's where this trade sours. Well, then I only have 2% risk, as opposed if the trade's all over the place, it would be normal if it went down 20% and hasn't even gotten to that low yet. So I'm going to back into the risk. I'm always backing into the risk. These are a couple examples I'm going to show you here. And what we call this trading near the danger point. This actually goes back to Livermore. Livermore in the 1920s and 30s, he talked about trading near the danger point. And that just meant trading close to your stop, right? Backing into the stop and making that stop as tight as possible, but bringing that into that math into the decision, the selection, and the charting, the decision of selecting the stock. In this particular instance here, you can see stop here is at the low of this little pullback here. And this is basically just a little, you had a gap here. This is playing a continuation from a gap from a little VCP. You had a little cheat area, little pullback buy turning up here. I was buying this right here. I think this was the Arctic one that makes the Forerunners, if I'm not mistaken.
Yeah, I remember this one.
Yeah, I don't have the name here, but I think that's what it was. So now I'm trading close to the danger point where I'm mathematically pretty, not too far away. This isn't like this is 20% away to the bottom of this pullback here. We had a nice gap here. If this is really this strong, this low should hold. The stock should go, right? So now I've married the technical stop with the mathematical stop. Another one was Medivation. This is one that I actually missed. It came out over here, and then it based for a little while, and I had not traded it here or here. And then finally, when it moved up here, I was looking back going, wow, I had a couple opportunities. This thing's really acting great. I decided to buy it on a pullback, which, again, natural reaction. Everything just builds on what we previously talked about. This pulls back pretty naturally. We get, I don't know, 1, 2, 3, get 4 lower lows. I'm looking for support right there around that 4th lower low, pulling right back to the top of the base, pulling right back to the moving average there. That's a 20-day moving average. Right there is where, if this stock's really under accumulation, it's so powerful, the buying should come in relatively soon. So I'm getting a really cheap look here. I'm getting a really, a cheap trade because I'm trading right near that danger point. If it comes below there, well, maybe I'll start reducing. If it comes down, gets it to this area here, that's where the trade is starting to sour. So again, mathematically, it's a very small stop, but technically the trade sours at the same time. That's backing into risk. Actually, I think it's time to take a break. So we're gonna take a break, and then we're gonna get into more about risk management here. There's so much more to go on risk management, but we're gonna talk about position sizing. We're gonna talk about when we come back, progressive exposure, which is one of the most important topics or ways to deal with risk, in addition to stop losses and what we talked about already. So let's take a quick break. I'm sure you guys are your head is filled with a lot here. I think we're just taking 5 minutes here, and then we'll be right back.
Okay, guys, that was part 1 of 3 parts that will be encompassing the risk management section. So let's take 5 minutes here. I would suggest getting up, doing some jumping jacks, get the blood pumping. We'll be coming back with risk management part 2, progressive exposure, after a 5-minute break. 3 parts on risk management, 6 sessions for the entire day, but risk management is really 3 parts. So 5 minutes, we'll bring it back. Go ahead and take a break, and we'll see you in a few minutes.